and we'll get started. All right, guys, thank you all for joining us today. This is going to be a strategy for bear markets. Now, when I say bear markets, it doesn't need to be the overall equity market. It could be a particular individual stock that we're looking to go into a bear market, or has just started going into a bear market, and you want to take advantage of some of that pullback from maybe a big rally or something along those lines. Before I get started, I just want you guys to all know that this is being recorded. One thing I say at the beginning of all of these webinars is, if you're not familiar with options and or this strategy in particular, go back and watch it relatively soon after seeing it, within a couple of days for that matter. And the reason why is because the first time through, a lot of these nuances might go by you rather quickly, but after you watch it again, it'll really make it start to sink into your long-term memory. Got a couple of things to go over before we get started here. My name is Eric Wilkinson. Some of you may recognize me from CNBC, Fox Business, or the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. And I actually started trading in college with a psychology degree, and decided to switch it over to finance. Upon graduating from college, I moved up to Chicago to work at the Board of Trade and have been trading my own money ever since. And I'm not one of those guys that's going to tell you that you're going to be rich or make you a millionaire, but I am here to help you take control of your finances, manage your own portfolio, and most importantly, take control of your own risk. If you have somebody else managing your money for you, that's eating into the yield that you would actually be making on your own. They're making the same mistakes that you would make, and you're actually paying for them to make those mistakes, if you will. So take that yield away from them and put it into your own account. Anyway, I've traded in most markets throughout my career. I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all of these products in all market conditions. One last thing to go over real quick. This basically says any opinions, news, research, and or information provided by Pro Trader Strategies, associate companies, or employees is for general commentary and does not constitute investment advice or solicitation to buy or sell any of these securities or strategies. Basically, what we're saying here is, without knowing your risk parameters, without knowing what's in your portfolio, it would not be financially suitable necessarily for you to just jump on board with what I'm doing. I've been trading for a very long time. I probably have a higher risk tolerance than some of you. So you have to take what we teach you here and implement it into your own portfolio in your own way. In that, keep in mind your own risk parameters and what makes you comfortable. That's what this is ultimately about. Also, I'll probably be talking about some securities that I may already own or be bearish on. So take that for what it's worth in your own eyes. I'm not trying to get you to jump on board with me. That's what I'm trying to say. I'm just trying to teach you how to take these strategies and implement them in your own way. Bottom line is, do your own homework, and past performance of any trading system or methodology is not necessarily indicative of future results. All right, so this is going to be creating a short stock position for bear markets, but using options. Now, with Regulation T, if you have a margin account, which is what most people probably have, and you wanted to short something, you're going to have to put up about 50% of what that underlying is. Let's just say, for instance, it's a $100 stock. You're going to have to put up $50,000 in margin. Well, with this particular strategy, you're only going to have to put up about $25,000, if you will. Not that necessarily that everybody is going to be doing something like that, but it's a quarter of what you would normally, or actually half of Regulation T, by using options. So we can use all kinds of different ones. Maybe a $50 stock, that's going to be about $10,000 or something along those lines. That's on a bigger quantity. It'd actually be about a little bit less than that. I'm thinking in larger quantities, but think about it as Regulation T is about 50% margin for that underlying. So in that regard, let's say a $50 stock would be $2,500. With this strategy, it's going to be about $1,250. Welcome aboard, somebody in from Steve Bigelow's class. Thank you very much, Farhad. Anyway, so keep that in mind. So that's why it's more beneficial to do with this. Another advantage to this, I'm going to go into great advantages here, but a couple that I don't have listed. One thing is when you're doing it with options, you don't have to pay the dividend if there's a dividend. When you're borrowing stock, you do have to pay that dividend. Another thing is you don't have to wait for an uptick to get filled, so you don't have to wait for the market to start rallying in order to short that stock. One other advantage that I came up with a little bit later than that was there's no need to literally borrow the stock, or there's some that may be not marginable. So this will be able to create a short position in a non-marginable short stock scenario, and that's usually when the stock is relatively new to the market and stuff like that. So it's maybe something like Fitbit when they weren't having when they first started releasing. Is this IRA friendly? I'll show you ways to make this IRA friendly, Camaro. So keep that in mind when I start going over all of it, but you can make this IRA friendly. All right, so and this is great for overbought stocks. This is what I usually look for when they've really had a massive rally, and you know, people are, whenever a market has a massive rally, 10-15% increase right away, relatively quickly, there are people itching to get out of that stock, and that's when you usually will see somewhat of a pullback. If you watched my one on the synthetic long stocks, I talked about that same thing. When you see a pullback of maybe 10 or 15%, that's when I would look to start implementing something like this. I don't want to buy a stock on its high, and I don't want to sell a stock when it's on its low. So at the end of the day, I'm looking for something that's had a big run up, or maybe some bad news coming out. Maybe like, for instance, Wells Fargo, or on the other side, Apple. You know, be a little leery about selling Apple today, but we'll have to look and see what it looks like on Monday. But they've had a massive rally from some of the Samsung news and things of that nature. But something along those lines. Those are the first ones that come to mind. I don't know that I necessarily want to start shorting Apple right now. Anyway. Or if you have, like I said, a bearish assumption, bear markets, if this is starting to really start to trend, maybe it's you know, you're starting to see lower highs and lower lows, which is a typical bearish market trend. Or if it's a pairs trade, for instance, you know, Intel came out with some really good news today. Maybe you wanted to sell Oracle, or not Oracle, Adobe, or something like that. That would be somewhat a correlated stock or underlying. Or if you wanted to go to the banks or something like that, maybe you wanted to buy JP Morgan and sell Wells Fargo. That would be a situation where you could do the synthetic long stock and then this with the synthetic short of Wells Fargo. Hedging. Now, this is basically, a lot of portfolios get really long deltas, and if you haven't watched many of my webinars and don't really know what long deltas mean, that means when if you are just long stocks in your portfolio, that means you are straight long the overall equities, and that means you're long deltas. Long deltas mean you have a positive bias. Now, if you wanted to add a little bit of short delta to kind of neutralize it, maybe capture some of the downside and maybe not hurt your portfolio as bad if there was a pullback, then this would be an opportunity to start selling some stock alongside with your long portfolio. And I kind of mentioned this, the portfolio delta adjustment. That's when we have a tendency to get very long deltas in our portfolio because we like to buy stocks, especially in the last couple of years. Stocks have just gone straight up, but are we starting to see a tipping pattern? That's yet to be seen. We're starting to see some volatility creep into the market, which could indicate that we may need a delta adjustment. So it's the same risk parameters as the short stock position. And there's different ways. I'll show you where it's not really exactly the same, but I'm going to try and show you ways to make it that same simulated short stock position. Because if you're shorting a stock, you're probably selling 100 of that underlying short, which means you are short 100 deltas. So I'm going to show you in the options how we can create a situation where we are getting short those 100 deltas. And if we're doing it IRA appropriate, then it's probably not going to be exactly short 100 deltas. Now, excuse me, and it's going to be using 50% less buying power. Now, if you watch the synthetic long, I said it was 25% less buying power. Well, that wasn't in regards to regulation T. This is in regards to regulation T, where you have to put up 50% margin for that underlying stock, and this is actually going to be 50% less than even regulation T. So it's a nice way to use a lot less margin. It's a lot less margin intensive, and in that regard, if it's less margin intensive, it's going to increase our return on capital, because if we're using less capital and we're getting the same type of risk and reward, then our return on capital will be much higher. All right, so how to set this up? We are going to be selling an at-the-money call, which doesn't make this IRA appropriate, and then we're going to be buying that same strike at the money put. Now, if you wanted to make this IRA appropriate, then you would buy a call pretty far out. It depends on what your risk is, though. If you wanted to make it really synthetically look like a synthetic short stock, you can literally buy the call to cap that loss at like a 1 or a 2 delta even, which I wouldn't allow this position to go that far against me anyway, to go to that 1 or 2 delta, but it would make it appropriate and act like the synthetic short stock. All right, so first things I always go over, keys to success. Picking the right underlying. We want to pick something that has a lot of open interest and volume. We don't want to pick something that nobody really trades. Pfizer's for one, Pfizer everybody knows about, but you get into that options chain and those bid asks are really wide. So even though it's a real popular stock, does not mean that it is necessarily the right underlying for the options, because the options just don't trade enough around that particular stock. So something like that would be discounted. Now, one thing I always say with the right underlying, it means if we're looking at stocks that are trading under $100, I like to look for a bid ask that is no more than 10 cents wide. Now, if, for instance, it was 13 or 14 cents on a $100 stock and I really was bearish it, I might bend that rule just. But if it's 50 cents wide, there's no way. If it's 25 cents wide, I'm not even going to look at it. Which, Pfizer is one of those where it's like 25 to 50 cents wide. And the reason why is, especially with a stock that may be going down rapidly, those bid asks will get wider when the going gets tough. So if it goes from 25 cents and it starts getting crazy, that could go out to $1 wide, and that you could be directionally right and have to give up so much edge to get out of this strategy that you will not be able to make money. So keep that in mind as well. So pick something that has a lot of volume, open interest, and a tight bid ask, because when the going gets a little wanky, it's going to be harder to get out, and there's just not a lot of participation in there, and you might have to wait days for somebody to come in there and happen to see your order in there. So try and pick something where there's constantly people in there, and then that way you don't have to give up as much edge to get out. Now, picking the right strikes. Everybody, this might seem counterintuitive because we're picking the same strike at the money, but what I like to do with this strategy is try and collect a credit. Now, it doesn't make that much of a difference. I just have a thing against paying debits. So if you don't mind paying debits for this strategy, it's not that bad of a situation. But I always try and look to collect a credit. I don't like to pay a lot for my options. How do I find these stocks scanning, Trevor? Yeah, I do scan, or I used to scan a lot. Now I've got my list of probably 75 stocks that I found that are really good, and I can show you them on my watch list. But every once in a while, I do still go back to the scan. They don't really give you a lot of information as to what the options bid-ask are, but if you look at something that's getting over 1 million contracts traded on that underlying, usually the options will have a tighter bid-ask. But that's not always necessarily true. Sometimes there's underlyings that don't get traded very much as a stock, but the options are really gangbusters in there and have tight bid-ask. All right, so and picking the right duration. Now you want to have this on long enough for you to be right. So I usually look at this. If you guys look at trading options, usually when I'm selling for a credit, I usually try and go inside at 35 days. With this strategy, we're not really going to be worried about the theta decay because this is the theta decay chart. We're not as worried about this, but we want to be out here in time somewhere outside of 55, 60 days, and as far out as you can go, really, in order to allow that strategy to work out. If it, if you're inside of this time, you're really kind of a crunch for time out here. Not that I'm going to hold it that whole time, but it just gives you a little bit more time. And you will notice, I'll go through several examples on using different brackets of time. You can get out here pretty far and still be at reasonable prices in comparison to if you were at shorter durations. Trevor, you're asking, what do I scan for? I usually just put on the scan for stocks trading. I go for $500,000 all the way to the end, and then I do stocks from basically $25 all the way up. And one of the most important things I usually add to a scan is IV %. But I just do that down in the box at the bottom. I just add that so when it populates at the bottom, I can see what the IV % is down there rather than scan for IV %. All right, and picking the right environment. Excuse me. So this is along my lines of keys to success. This one isn't necessarily as important as it normally is for when I'm doing option strategies that are, let's say an iron condor or a debit spread. The reason why is because volatility isn't really going to affect this, and that's what I usually mean by environment, knowing what our implied volatility environment is. So that being said, the volatility is really going to offset one another. With this one, how do you get out prior to dividends and earnings, Larry's asking. Now, the dividends aren't going to necessarily affect you as much with this one because we don't have to pay the dividends. You would have to worry about early assignment on the call if it is in the money. But at the end of the day, we're going to try and look for stocks that really don't have dividends or earnings in them necessarily. I don't like to hold these in through that kind of binary event. I have a plethora of other strategies that I would like to do around something that has dividends or earnings. A great question. And then know our exit strategy before entering the trade. I usually look at, on worst case scenario, if it goes 10% against me, that's when I am looking to get out. But that is my particular rule. You guys need to really think deep and think about, if you were long a stock even, might be the easiest way to think about this. At what point do you exit that long stock? that it goes against you? When are you willing to get out? It should be a very similar situation on shorting a stock, having it go that much against you. At that point, when do you pull the ripcord, as we used to call it on the floor? You know, you pull out your parachute and say, I'm done free falling. But that's something you need to really look at for you. I usually say a rule of thumb for me is about a 10% correction in that underlying. That's when I'm going to start pulling the ripcord. The other thing would be, if you are a chartist, like there's a lot of people in here from Steve Bigelow's class, so I know you guys are very well versed in charting. If you are versed in charting, then look at it when it breaks your level. If you got a indication on shorting this underlying, then as soon as it breaks above that previous candle, that might be the time to pull the trigger or pull the ripcord on this. All right, so your max profit is achieved when the underlying goes to zero. Now, I'm not, like I said, I'm not going to take it that far. I'm usually going to look at Fibonacci levels and or the charts to determine when I'm going to get out, and I usually look at that and know where that level is before I get into this trade. So I know where my exit is to get in and where I am looking to get out on that particular underlying. So look at it for that, and the same thing goes to the other side. On the flip side, to get out on, say, a stop would be to look at getting out. Sorry about that. So look at those different levels, or you could look at it as a 10% correct to get out, or 10% wrong to get out. And then your max loss is infinite, because we're shorting a stock that could theoretically go to $1 million a share. Not likely, or more. Infinite means it continues to go past $1 million a share, but what's the likelihood in the next 100 days that, you know, a $25 stock is going to go to $1 million a share? Not likely, but you have to know what your max loss is. And break even is going to be the strike price that we choose plus the credit. So that would be, if we did the, say, 100 strike for the calls and the puts, and we collected $1 credit, that means our break even is at 101. Or if we did the 100 strike and we paid $1 debit, our break even would be at 99. Now, what I try to do when building out this strategy is I want my break even to be above where the underlying is trading. So in that regard, if I was doing the 100 strike and the underlying was trading at, let's say, $100.95, I collected $1 credit, my break even is above where the underlying is trading. So it gives me a little wiggle room. I'm already, upon entering this trade, successful in the sense that we are already in the money. So that's something important to take away. One problem with doing synthetic short stocks is that puts inherently have more premium, more skew to the put side. So it is a little bit more difficult than with doing the calls, doing the synthetic longs, to get our break evens to where we are already in the money. So keep that in mind. I got several examples, and I think I vetted like 10 different stocks, and most of them were where the break even was, you know, a few pennies below where we were already trading. So, but I've got like one or two that had the break even above us. All right, so I know all of that stuff is boring, so let's get into the platform and look at some different stocks that we might want to put this strategy around. And somebody was asking about the scan. If you can see, this is the stocks that I like to trade the most, or that I have found that has the tightest bid-ask on the side here. So, and to be quite honest, I don't even know what all of these stocks do in some regard. I just go straight to the options chain and look at something like Visa, which is a $80 stock, and look at the volume and open interest on Visa. I mean, even out 91 days, we have, you know, a lot of open interest, and you know, an $80 stock, it's got 5 cents wide, 3 cents wide. You know, I mean, so that is a nice tight market. And you will look at the ones that go into the money; they get a little bit wider, but know that with this tight of a bid ask at the money and the open interest around those, that there's people in there with different types of spreads that may not necessarily show up here, but the algorithms will automatically fill you a little bit better. But you know, that is going to be an issue we want to deal with when we get that deep in the money. But knowing that, you know, the 65 strike is $1 wide, and something that has this tight monies, this will tighten up as soon as you start putting your offers in. Or actually, since we're selling the call, it would be putting the bid in. Quick thing to note before I forget about it, to make this IRA appropriate for Visa, we're going to be looking at building this strategy out. What's the closest to the at the money? It's probably these 82.5s, but I would be paying a debit for it. And like I mentioned before, I don't like to pay a debit. If you're worried about assignment risk more so, then you might want to pick the calls that are just out of the money and pay that debit. I usually don't look at it that way, but we're going to be selling the calls here, and then we're going to be buying the 80 calls. Now, we add this credit to here, so 82.02 is our break even. So the underlying has to trade slightly down from the last trade in order for us to be in the money. But like I said, a couple of pennies below where we are is acceptable for me in this regard. Now, to make this IRA appropriate, what I would do, see, I talked about this, I'd probably be looking for about an $8 down move or to get out an $8 up move. So if it's trading 90, that's where I'm going to be pulling the trigger myself to get out. But if you wanted to make it IRA appropriate, what I would do is go out here just really far, where I would never expect to, you know, get out, and buy the first one that is like a 1 delta, so, or that I can pay a nickel for, is usually what I look at. You know, if I can pay a nickel for it. You know, if you're playing in Priceline or something like that, you might go a little bit tighter, but at the end of the day, it'd be where the first strike that I could pay a nickel for. Okay. Here's the thing I was talking about, deltas. If we were to short this, that, like I said, you're selling 100 of the underlying, that means you're short 100 deltas. What is that? The definition of delta is that for every dollar move in the underlying, the delta tells you what the premium is going to change. So if we're just looking at the calls in this regard, if Visa goes down by $1, these option prices are going to decrease on the first dollar by 61 cents. Okay, so that is where we're talking about delta in that regard. If it goes up by $1, these increase by 61 cents. So the delta tells you what this underlying is going to increase or decrease by for every dollar move in the underlying. But it also tells you, so in that, we want it to act like we're short the underlying. So if it only moves 61 cents down for a dollar down move in Visa, then we need to add more short deltas to this. So how do we do that? By buying the puts, which is a 39 delta. So you know, we're getting short deltas. So if you buy these deltas, that means, or buy these options, that means you're short 39 deltas. And then if you sell these options, that means you are negative these deltas. So negative 61 plus negative 39 is negative 100. That's how it emulates that short delta of 100 of the underlines. Does that make sense to everybody? Because if it goes down by $1, these premiums are going to go down by 61 cents, and if it goes down by $1, these premiums are going to also decrease by 30 cents. So that would mean that the dollar move in the underlying would make our total premium go down by $1. Does that make sense for everybody? Actually, I'm sorry. These, I said that wrong. As the underlying goes down by $1, these are going to decrease by 61 cents. And as the underlying goes down, these are going to increase by 39 cents. So the decrease here and the add here makes it $1 even in our premium. Increase in value because we're short these. We make money as this goes down, and we make money as this goes down because it increases. So we would lose 61 cents here, which is what we want, and we would gain the 39 cents here, which is what we want. Now, the further we are correct in this is where it stops acting exactly the same, because as you could see, if we had sold this and gone had our puts go into the money, we have an 88 delta here, and going across the way we have a 5 delta, so it's only going to be reacting by 93 cents. So it's not the perfect scenario where as if you're short, but again, I'm likely not going to be holding it to that position anyway. So but know that the further that we are right and or wrong, it's not going to necessarily act as 100 of the underlying. But it's close enough for, you know, if I don't know if you're counting pennies or not on a winning trade, but I'm usually not. So that's what makes it a little bit different than having it the other way, having it just short the stock. All right, so this is usually where I kind of go out and throw it out to you guys, throw out some stocks out there for me to kind of vet, and we'll go through it. So for instance, like I said, one other thing to note, if we were to short this underlying, sell 100, it would be $4,100 is the margin you would have to put up. If we were to sell this one, then our margin is going to be 2,050, most likely. Let's see, or it's even less than that. It's less than $2,000. But to short this, regulation T would say that you would have to have half of the $8,219. All right. All right, so the first one we got Wells Fargo. That was one of the ones I vetted because now, Larry, I'll have you. This doesn't go in line with my thought process of, you know, something that has sold off, but there is just so much bad stuff coming out about Wells Fargo. There's, you know, and I can tell you my point or my viewpoints on it. You know, I can't see how 5,000 employees are doing all of this nefarious stuff, and upper management was not a part of it. But now employees are starting to say that that if you were doing those nefarious practices, then you were likely promoted, and if you were promoted for doing those nefarious practices, they're probably teaching it. So so anyway, I could easily see it want to come down here and test that. You know, I mean, it's going to be dependent on tomorrow or on Monday, but if it breaks much below that, I could easily see it breaking this tweezer bottom. I just I don't see Wells Fargo faring very well going forward. I think the CEO is going to go down too. So I'm with you on that. So in that, let's look at the breakdown. So we got the November. I want to get out at least 60 some days. We'll look at the two, see which one's the best for us. So let's look at the November. It's trading 45.40. So I would go to this one only because this way I know I'm going to collect the credit. Usually the calls in the money will give you the best one, and then buy the puts on that. So we're collecting an 18 cent credit. So we can look at that. So we add the 18 cents. So it 45.18 is where our break even is. So we would have to lose about 20 more cents in order to get this to work out. It actually, when it was trading earlier, it was trading around 28, and I was really close then because it was still around 18 cents. So, you know, this is one that I like. So then let's just compare it to the ones out here. Make sure one thing, double check, make sure your deltas are 100, and they are 46 and 54. That's 100. So let's do it with the 45. Excuse me, I have a tickle in my throat that started at the beginning. 18 cents. So, you know, for 18 cents, you're, you know, at the same place. That is why I would go further out in time for this one. It's important to note that the break even is at expiration only. And yes, that is true. That is true. It is really only at expiration, but, you know, it's also a psychological thing. It's nice to know you're already in the money. You don't have to work too hard. But yes, it really does only make sense at expiration. Good point, John. How does the theta affect this? Well, the theta is going to be pretty dead on for the most part. As you can see, the theta is -1 and -1. So the theta is going to affect the two options the same. So it's not going to be a factor that much, and nor is the vega. As you can see, the vega is going to be offset as well because it's an 11 and 11. And as you can see, if we go deeper in the money, it's going to, the further away and deeper in the money, it could start getting a little bit different or getting a little offset. But like I said, with this one, it's a $45 stock. I'm probably going to look for a $5 correction in either way. And in that, it's not going to get off that much. It could start getting a little wanky if you really let this go for a long time. But at the end of the day, they're going to offset each other for the most part. And that's why volatility isn't a factor. If you guys notice, I haven't even talked about vol increasing or decreasing because it's going to, as the market goes down and this goes deeper in the money, you know, the volatility isn't going to affect it very much, but it is going to help us in this regard. Or it could, if it really happens fast, it could help us because it's going to go deep in the money. Volatility isn't going to affect the ones going out, but the ones that are in the money will still be affected a little bit there. So that could help us out there. Yeah, let's look at the strike for the 46 strike. We're going to look at the 46 strike for Wells Fargo. So I'm going to sell the calls, buy the puts. And with this, I always build out my strategies. I don't ever really look at it like, you know, going up to the outside of the single, because I like to do my strikes, and you end up having to play around with it when you do theirs anyway. And I don't think they have anything for synthetic shorts anyway. But to do that, you would hit sell and then hold down the control button and hit buy for some people that may not know that much about how the workarounds do. But the 46 and the 46, so we sold the 46 calls, bought the 46 puts, and we're paying an 85-cent debit. So we then subtract the 85 cents from this, and that puts us at 46.15. So our break even is 15, and the other one was 45.15. Sorry, 45.15, and with our break even on the 45s was 45.18. So our break even was even a little bit higher with the 45s there. So we can look at it with the further duration in the January. So we're going to do the 46. So we're going to sell the January 46s, buy the January 46 puts, and that puts us at 84 cents. So you're actually paying, the other one was 45, you're paying a little bit less to go out further in time, which is better. So that's, you know, it better serves us. So that would be something to note for sure. I mean, it's a penny is a penny, right? And again, with this strategy, if we're looking at Wells Fargo, I would go to the first one that I could pay a nickel for to cap it off, and that's right here at the 57 and a half calls. So you could then go and buy the, hold down the control, buy the 57 and a half calls, and that makes that IRA appropriate. That makes sense? Every time you trade a spread, you are virtually eliminating the impact of the theta and the vega. Isn't that right? No, that is not right. If you're just talking about any time for any type of spread, no, that's not true. Because if you were to do a vertical spread, and say, for instance, sell the call and buy it to define it, you can see that vega is going to affect the nearer term one more than it is the further duration one. So that's not necessarily true. And same with theta. If we look over at the theta, you can see the theta is affecting the closer than it is the further. But because we're buying one and selling one, it is going to relatively offset one another. It's not going to be that much of a difference then. But vega is for sure going to make a difference on the spread, which is what I'm most concerned about, is the vega. So, all right, what was the other one? Somebody threw out Adobe. Now, I would be a little concerned about shorting Adobe only because of Intel's news release today. I don't know if many of you guys saw it, but and Intel probably reacted a little bit off of that, or Adobe, I mean. But Adobe, Intel spiked a lot higher. And this was off of, they came out and said that they were going to be, I think it was well over $500 million more in sales this year due to PC sales. So Adobe will be affected by that too. They haven't released anything, but any of these ones that are dealing with a home computer, I would be a little bit nervous about, but in that we'll still look at it. That's because I don't want you to necessarily go with what I think, because I might not know anything. All right, so you would sell the one that was slightly, and these are 20 cents wide for Adobe. Usually Adobe has a lot tighter markets. Yeah, and usually it's inside of 10 cents. That's what I thought, because it's one of the ones I usually look at. But this far out, it's looking a little wide, so might not just give up. I might not go mid-market on this then. What's the volume and open interest out here? Oops. Let's look at the volume and open interest. I mean, it's got some volume out there. I'll look at it anyway. And then buy the 95 and a half, which is probably the closest to where we're trading, 99. I guess it's a crapshoot either way. So $1.62. So we add $1.62 to this. That gives us 99.12, right? Did I do that math right? 99.12, 8, 9, 12. Yeah, 99.12. So that puts us where our break even is above where we're trading. That's nice, because the underlying's trading 99-ish. So that would definitely fit in there. But I would probably even uptick it a couple of ticks and then work myself down. And I usually do this with just about every single trade that I do, is go to mid-market, add, if you're selling it for a credit, add it, get away from the mid-market so it's beneficial to you. If you're buying it, bid lower, and then uptick it a little bit here and there. If you don't have cancel replaces, you're giving up edge. So always do the cancel replaces if you have the opportunity. If you're a short-term trader, say hold less than 20 days, why would you ever buy and short a stock instead of using synthetic long and short strategies? Pros, cons. Jeffrey, that's a great question. The only time that I would short a stock is when it's put to me, to be quite honest. I don't know why you would. And I think it just has to do with, sometimes hedge funds and things of that nature want to go for longer duration, but still, you could always roll this out in time and even go, even if you go out to these really long duration ones, you're still, especially in a popular stock, going to be able to get a relatively close to the same credit and or debit that you would normally. I think it's really naivety or ignorance, if you will, that people are always afraid of trading options. They think they're more risky than everything else, and the fact of the matter is they're less risky than going out and buying or just selling a stock. So I think it just has to do with public perception, and people just don't understand. If you right-click on the strike price, then buy synthetic collar combo to execute these types of trades. This is how I trade all of my options. You'll get a credit when you synthetically short equities due to the skew. Yes. Thank you for that, Beth. I'm glad you're covering the strategy. Appreciate that. Yeah, you could probably go up here and do that. And I've actually done on strategies on the different types of even the synthetic collars and things like that. So yeah, you could look at it doing that way too, for sure. I like to just build them out myself, just so I know what I'm getting. Especially with if you're looking at like an iron condor or something like that, where because then you have to go deep and wide or whatever, and I just much rather go to the strikes that fit my rules and build it out that way. Will you roll this? Larry, that's a good question. I usually won't. I usually try and ride this to my profit target and then get out. Profit target or my ripcord pull to get out. So I usually do it that way. Especially when I'm doing with 121 days, I'm pretty much done with it. I don't like to hold anything, like Jeffrey said, I'm not a long-term trader in regards to where I wouldn't want to be holding this for 120 days necessarily. There's just the probabilities are going to start working against me. Profit diagram, do you mean on the Analyze tab? Is that what you're asking about, Jan? Okay, so, and were you talking about WF, or was that a typo? They don't have any options. So let's look at Wells Fargo, I think maybe you were talking about. So let's look at Wells Fargo. Okay, Wells Fargo. All right, let's do that for sure. So first off, let me do this. Let's go, okay, if we were going to sell this as an underlying, and we're going to analyze this tab, right? Let's do the analyze this trade. So this is our profit loss, right? We're going to, as the market goes up, we are money at that diagonal, and I don't know what that angle is, to be quite honest, but now let's go into the trade and look at it as if we were going to do it as the way I build it out usually. So we're going to sell this call, and then we're going to be buying this put. Whoops. Buy that put, the 45 strike. We get an 18-cent credit. So to make it equal, let's look at that, and then we can analyze the tab. Wait, one thing I want to do before I analyze that real quick, I want to show you what. So max profit is the 4,500, but you can see here we only have to do $1,000. If we were going to do it according to Regulation T, it would be $2,250 that we would have to put up. One thing with selling it is you would get the $4,500 credit into your account, but that's also neither here nor there because it doesn't really count. All right, so analyze this trade. So as you can see with the stock, it is just slightly better analyze, but with the options, which is the blue, it is essentially the exact same risk diagram. John's asking, do you have Iron Condor and credit spread courses also? Absolutely. I do. Which I would love to get back to some high volatility environments, which we kind of got an inkling of this past week, but yes, I definitely do, and I go through all my rules for that too. The keys to success. All right, so and I think I can squish this up so we can get even more of a, you can get the big picture view of, you can continue to lose money there. All right, it's not going to let me go too far out. Okay. Any other questions real quick before we start wrapping it up? How about the Wells Fargo with the 45 calls, 45 puts, plus the, do you want to see what the risk diagram is on that, Jan? So let's just do it with the 47.5, or the 57.5 calls, because we're going to buy those to define our risk to make this IRA appropriate, to cap it. That's what I would do. If you're not comfortable with that, you can go a little further down, but keep in mind, your break even is a lot further down to achieve it. So let's do this as an analyze. So I'm going to have to cut off some of these. Let me cut that one off. Let me cut that one off. And then there you go. So then you've capped your loss if it goes above 47.5. But keep in mind, I would probably be looking to cap this thing off if it was, 10% correction, so $5 or something. So I'd be out at like $50 if it rallied up to 50. And again, this fits right in line with these Fibonacci levels. One thing I would probably do, the one reason why I usually like to buy stocks once they get below this value area low and come back in and settle. But if it were to settle, on Monday or trade below this, which I was really keeping an eye on it today, to settle below yesterday's low, I think it's easily going to go down and test this 45 and probably go below that before it's all said and done. And if the Fed doesn't raise rates on Wednesday, then all the bank stocks are going to get hurt. So keep that in mind also. I've been talking about that in my daily market commentaries if you guys have been watching those. All right. Does that answer your question, Jan? Does anybody else have any last minute questions there? All right. The support on Wells Fargo stock looks to pretty close. So even so, is it even worth doing? Well, that's a good question. You know, I think Wells Fargo hasn't seen this bad of news in probably their history. As a matter of fact, they were the biggest bank, and now I think J.P. Morgan just overtook them with this big sell-off and all this news. The question is do you think that everybody's gotten shaken out? I mean, 5,000 people, you guys, were doing nefarious practices and putting credit cards in people's names that didn't know it. So they'd get somebody signed up for a new bank account, and they'd give them their debit card, and then all of a sudden they had a credit card that they were getting late fees on that they didn't even know existed. 5,000 people. There's no way that 5,000 little people were thinking that nefarious unless somebody in the higher ups was giving them the, you know, yeah, this is what you do. So I'm under the guise that the upper management is going to get in a little bit of trouble. So this isn't one that I would normally look to do. I was actually looking at, also, we got a little bit long, I was looking at like Las Vegas Sands. So Las Vegas Sands looks like it could be topping out. It's well above, it's overextended. You can see the volumes really starting to thin out up here. It's going to want all of these people that have participated in this massive rally all the way up here are itching to get out. And any type of pullback, these guys are going to look to cover. So this is really where I like to do it. You know, people say, are you catching knives when it's falling down? I'm contrarian, so it can't continue to have this kind of vertical lift forever in my eyes. So this would be where I would start piecing it in pretty small, look for any kind of weakness and jump on it. Oh, this is Chris. Okay. Sorry, Chris. All right. So this is the floor trader hacks for options deal. We did this last week on the last one, and this probably won't really work for all the guys that did Steve Bigelow's class. But anyway, you get all of these floor trader hacks. You actually get a couple of more, so it might be well worth it for you guys to have it. There's I only did a few of them. There's several more involved in this particular package, so this is a really good one. This is a way to speed up everything, you guys. So especially if you're not new to options, and even if you are a savvy options trader, I can assure you that there are some things in here that us floor traders looked at differently to the person that is the retail trader, for instance. So we look at delta in several different ways that you would look at it normally as a retail trader. I also go into volatility, how you can see what volatility crush is, which is really important, especially if you're an earnings trader. You can really figure out how much volatility is going to come out of those options in the next few days, and I show you real quick ways to figure out if it's at 110% volatility, how you can figure out where that volatility is going to be after that binary event, and then in that you can figure out what your pricing is going to be and what you can expect to come out of those premiums. And also, I talk about the probabilities of trade, because everything is about probabilities, you guys. If you can make the probabilities in your favor, just like if you were a card trader, if you go into the play Texas Hold'em or something like that, you see all the probabilities that these guys are looking at and doing in their head. They're figuring out what their probabilities of winning are versus what the payback is on the pot, and that is a huge thing. If you've got pocket eights versus pocket aces, well, if your chances of winning are 1 in 4 and the pot odds are 1 to 6, you would do that all day long, because you're going to probably lose a couple of them, but the ones that you win are going to pay back over and above what you had lost if you continued to play the probabilities. That's how probabilities work. That's the way I play them with the with options. Is I'm always looking at the probabilities. I'm not. It keeps you keeps your powder dry because you can continue to play those probabilities, and over time the probabilities are the probabilities. They will play out in your favor. Also, several other shortcuts that you can go through and check out. So if you guys want to streamline your process for $500 or less than $500, it will well more than save that in just a few trades. So it's going to be well worth it. Also, if you sign up for this, you get unlimited access to me, which means like if you guys have a trade that's going against you and you want to know what my rules are and how to manage that, whether or not I would roll, where I would defend this particular strategy, then I can go through that with you and tell you what my rules are around that. I'd be more than happy to do that. The more educated we all are as traders, the better off the market is the way I look at it. You know, it's with options, you know, it's not, there's a winner and a loser like with stocks, or with, if you're buying a future, if a person buys the stock and a person sells it, well, it's a 50-50 probability that you're right for one, and it's one person's making money, the other person may be losing money. With options, there's so many different ways to build these things out that there's not always a winner and loser for every trade, because you might be actually putting on an options trade hoping to lose money on it. Like if you're covering a call or doing a cover call strategy, you actually, when you're selling a call against that long underlying, you kind of, you know, that's a tough problem to have that call go into the money, but that's what you want, because that's where you're going to make the most money. You know, if it doesn't go in the money, then you get to keep that credit and you lower your basis, so you paid less for that underlying. So anyway, I go through all of that stuff and how to play that all out, and you know, you can reach out to me anytime. Also, you get my daily market commentaries where I go through every single trade that I do. You know, it's up to you whether or not you want to implement that yourself. I can't tell you that it's the right thing or the wrong thing, because it goes back to me not knowing your risk parameters. But I go through and tell you and walk you through it. Like if I have a strategy that's gone against me, then I tell you how I'm defending that, how I'm getting aggressive with it, if you will, to try and defend myself. So that is invaluable as well. Is this more than your volatility course, or pretty much the same? This is, if you're talking in regards to price, I think it's relatively the same. These are completely different things, and one of these may be similar to the volatility course, or one of these may be in the volatility course with the vol crush, or at least similar. It's not going to be the same exact video, but maybe similar. And those daily market commentaries, you guys, you should watch those, because I talk about what, you know, is going on economic and with regards to economics, geopolitical stuff, and I give my market analysis on those. So those I think you would get a lot out of if you were to sign up for that. So take advantage of that as well. They're only like 10 minutes long, and they're like just little refresher courses on some of my webinars, so it'll help keep it top of mind for you. All right, so sign up for this. It's well worth the money for sure, especially if it streamlines your process in order to find better trades. John, what's my take on the market at this time? Good question. I am overall bearish because I don't think the economy is doing that well, and at some point the market isn't going to celebrate low rates. That's going to kind of be like, it's really counterintuitive. It's not working. It hasn't worked yet. What makes us think that it's going to work? The economy hasn't been robust by any stretch of the imagination. It has regained and recouped, but you know, at the end of the day, it is not robust. So I think that it's been a big disservice. I mean, you look at our financial crisis and you look at other economies' financial crisis, say Iceland, where they actually went after the bankers for their financial crisis, they recovered rather quickly. I mean, within a couple of years. And here we are. We're still kind of struggling. So totally agree, but when the hell is anybody going to recognize that? I agree. I mean, John, I don't know. I mean, it's bizarre to me that and our PEs are continuing to climb and be unsustainable. I mean, if you even just look at Tesla, I mean, for crying out loud, you know, if GM had come out with a driverless car or an autopilot and one crashed, can you imagine? Or I meant GM. Did I say GM or GE? GM or Ford or one of the U.S. car makers came up with a pilot, you know, a driverless car, a pilot, auto mode or whatever, and that car blew up or drove off the road, I mean, it would get massacred. I mean, you barely see a blip when Tesla has a car drive off the road or catch on fire. It's just, it's Teflon, and they're not making money. So, I don't know. You sell 10,000 cars a year, and their valuation is well over a U.S. manufacturer that does 10,000 cars a month minimum. So, I don't know. It's a little bizarre to me, but it's hard to be the contrarian right now. Or decapitate someone, for sure. Yeah, you know, we have an airbag that blows up and their stock goes down. But anyway, that's my soapbox. Anybody else have any other questions or anything else? And I talk about stuff like that in those daily market commentaries. If you guys, you know, I talk about that kind of stuff all day long with the daily market commentaries, what I think about what the Fed's doing. I talk about what each Fed governor is saying, you know. Do I ever trade CMG, or have I in the past? Yeah, I do trade CMG. I haven't recently. I did trade it during that whole E. coli scare. I think that they've done a good job around it, but I love that stock only because they've somehow convinced the world that, you know, a 1,000-calorie burrito is healthy. How do we log into the market commentary? Jan, I believe that's sent with you as part of the package. So if you log in, there should be they're in the members section. So check out, I forgot to say that link to this is in the chat box. So click on that chat box there, you guys, and you can get straight to this offer. And if you have any questions, you can call us at 310-598-6677, or Chris, you were asking about the daily market commentary. If you can't find it, just email us at trading@protraderstrategies.com, or you can call us. They can walk you through it. You guys, the guys that are going to be talking to you about this are options traders and are very savvy, so they will be able to answer any of your questions. And if they can't answer that question, they'll send it off to me. So, and I will personally answer it. And or if you even ask for me, I will answer your questions. I have a no inbox policy on my email, so I answer everybody. And no question is a dumb question. You know, if we have a question, ask it, because if you have a question, somebody else has had that same question. Also, if you guys have any other ideas for different options strategies that you want me to cover that you haven't seen me cover, for sure reach out to me and I will do one on it. There are some option strategies I don't like or I don't think are worth trading, so I kind of avoided doing them, like long butterflies and things like that. I don't like to trade, so I haven't really covered those, but I will if you guys want me to. So write to us, let us know, please. All right, guys, have a great weekend. I've gone a little bit over. I'm glad you guys all stuck around. If you can't take that, Take it easy.